Good morning. Welcome to ICG Enterprise Trust's Q3 trading update for the 3 months to 31st of October 2025. I'm joined today by Oliver Gardy and Colin Walsh, who will discuss our investment performance and activity in more detail over the course of this presentation. The slides for the presentation, along with the accompanying results announcement, are available on our website. We will have time for Q&A at the end of the presentation, so if you'd like to submit a question, please do so through the online portal at any point in the Q&A box on your screens. We'll then aim to answer those questions at the end of the session. With that, Oliver, over to you.
Thanks, Martin, and thanks everyone for joining the call. I thought firstly a few thoughts on how we're seeing the environment today. Despite heightened macro-political risks and market volatility, we believe that we see that the underlying private company fundamentals remain very robust, and credit conditions continue to be supportive of quite a dynamic transaction activity. That combination has translated into a strong period for realizations for ICGT. This has been positive for both NAV and liquidity, and we will go through some realizations later on in this presentation. We also believe that, especially in this environment, manager selection and balance sheet discipline are particularly important, and these remain core strengths of the portfolio and of our investment strategy, and we look at that data later. Finally, as we announced last year, we are increasing our medium-term exposure to secondaries. We continue to see an attractive opportunity set here, given its compelling risk-return profile, and we made a 90 million, in addition to a large co-investment in the previous quarter, we made a $90 million commitment to ICG LP Secondaries 2, post-period end. Before we turn to the numbers, a brief reminder of our focused investment strategy. Our investment strategy and our mandate is really designed to achieve private equity returns, but with less risk and more liquidity than a conventional private equity fund-to-fund. Our secret sauce is to achieve superior risk-adjusted returns, and the way how we do it is the following. We invest exclusively in mature buyouts, profitable cash-generative companies, primarily in developed markets, North America and Europe, where the depth and the quality of managers is the strongest. We invest in mid-market deals. The typical company size we look for has an enterprise value of about $250 million to $2 billion. Small by public market standards, but we think a sweet spot of good companies which can be transformed into great market-leading companies. And we partner with top-tier private equity managers with strong track records through the cycles. And together, this results in a portfolio of resilient companies with a more consistent return profile and where performance is not cyclical or seasonal. And with that, Colin will now talk you through the Q3 numbers.
Thanks, Oliver. So turning to the quarter in review, at the 31st of October 2025, NAV per share stood at £20.80. Over the quarter, NAV per share total return was 2.4%, with the portfolio delivering a 2.3% return on a sterling basis. So over the last 12 months to the 23rd of January, the share price total return was 17.3%. £51 million was returned through capital allocation, over half of which came from share buybacks. During the quarter, we invested £25 million, generated proceeds of £82 million, giving us a net positive cash flow of £57 million. For the 45 full exits we've had in the last 12 months, they've generated a strong return. So that's 3.1 times multiple of cost. And they continue to be sold above their book value, as represented by an 11% uplift, which you can see on the slide. And finally, reflective of market transaction activity continuing to improve, we also announced a further £75 million worth of proceeds after the period end. That's essentially from the 1st of November right through until yesterday. So just to focus on realizations, which have been a particular highlight in the year to date. After a muted couple of years across the industry in 2024 and 2025, in our financial years 24 and 25, you can see from the charts that we were roughly averaging £40 million in proceeds per quarter. This year, this is the year to January 26, has seen our quarterly average proceeds double to around £80 million. What's been especially pleasing is the breadth of businesses that have driven this activity. So ranging from Minimax, which operates in the fire protection sector, Froneri, which makes ice cream, David Lloyd, health clubs, DataSite, virtual data rooms. It demonstrates that our portfolio is able to tap into many different themes, many different secular trends. But the common theme across all these exits is a focus on high quality businesses and our managers' ability to execute deals, even in a slightly more difficult and more selective environment. And it also points, very importantly, to the exit optionality that mid-market focus that Oliver was discussing affords us. These are companies that aren't solely reliant on an open IPO market for exit. We have multiple different exit routes. So, for example, we can sell to financial buyers, strategic buyers, increasingly as well continuation vehicles. Year to date, total proceeds represent around 20% of the opening portfolio, and that's well ahead of peer averages. Just like to spend some time on the next slide, focusing on one of our largest realizations, which was Froneri. As I mentioned earlier, Froneri is a manufacturer of ice cream. It was our largest single company exposure at the end of July, accounting for around 2.7% of portfolio value. The business has been backed by PAI Partners, a high-quality private equity manager with whom we've invested for many, many years. Indeed, it's one of the longest-standing third-party managers in our portfolio, dating all the way back to 2005. Froneri benefits from a defensive market. It's a high-margin business model. It has resilient earnings, and that has driven very strong net sales growth. Our own investment in this company dates back to 2013, and we actually chose to reinvest in the company in 2019, really demonstrating the long-term time horizon that we work to and the long-term nature of our manager relationships. And this third quarter realization generated 41 million euros worth of proceeds. Now I'm going to spend just a little bit of time on our balance sheet. We remain in a strong financial position. At the 31st of October 2025, we had £230 million of total available liquidity, a low gearing ratio of 3%, and an overcommitment ratio of 27%. This robust balance sheet provides us with flexibility to take advantage of new investment opportunities, but also to continue to be able to enhance shareholder returns through both buybacks and dividends. Okay, so the final point I wanted to mention before handing back to Oliver was something we talk about quite a lot, which is the importance of manager selection. We said in our start of the year newsletter that the wider dispersion of private equity manager returns will become increasingly evident in the coming years. This means it is ever more important to continue to invest with top-tier private equity managers. That's managers with strong track records and experience through cycles. We currently have over 30 active manager relationships across the US and Europe. Names like New Mountain Capital, Cinven, Leeds Equity, Bowmark, PAI, the manager of Froneri I just referenced. Managers who share a similar investment strategy, focused on resilient companies, they deliver strong primary performance, and typically offer us attractive co-investment opportunities, which amplify our returns and allow us to invest in our managers' best ideas. We continue to enhance our manager selection discipline, and this is where our active portfolio management comes in. We're highly active in our search for new high-quality managers, with regular market mapping exercises scanning the entire addressable market in Europe and the US. The most recent example of this was our recent commitment to Stone Point, a new manager, in December 2024. We also trim the managers and funds, which even if they've offered strong historical returns, we believe they may sometimes we identify the fact they will offer lower go-forward returns relative to other uses of capital. And we've shown this proactively with 4 secondary sales over the last 5 years. Anyway, with all that, I'm going to pass back to Oliver to conclude.
Thanks, Colin. Talking about secondaries, we communicated last year that secondaries were presenting some really compelling investment opportunities, and therefore we also increased our medium-term target weighting to secondaries to 25 to 30% of the portfolio. We're currently at around 15%. So I'm pleased to announce post-period end, we committed $90 million to the ICG LP Secondaries Fund, in addition to the £20 million co-investment alongside with ICG LP Secondaries called Project Domino. And as you know, and as we are continue to be excited about secondaries, it is an increasingly important component of our portfolio. And in the alternatives market, in order to deliver private equity returns at lower risk, more liquidity than a conventional private equity fund of fund. And the market has grown consistently at roughly a 15% CAGR over the last decade, but has actually doubled from about 100 billion of transaction value in 2023 to over 200 billion in 2025, just within 3 years. And investors are attracted to the space, given it offers private equity type of returns with more credit-like risk characteristics and returns capital much faster than a buyout fund. Let's turn to shareholder distributions. Since October 2022, we have executed £70 million of buybacks, equivalent to about 8.4% of opening shares. Alongside this, we continue to run a progressive dividend policy, with dividends growing at a compound annual rate of 10% since fiscal year 21. And the board now announces a Q3 dividend per share of 9p for the full year of fiscal year 26. The intended total dividend per share is 39p per share. On that, I thought I would spend a moment specifically on buybacks. As many of you know, the Enterprise Trust was an early mover in our sector in launching our long-term buyback program in October 2022. And so that has been already over 3 years ago. This long-term buyback program is at any discount. And then in May 2024, we launched, in addition, an opportunistic buyback. And I'm pleased to say that our buyback programs have delivered clear and tangible benefits. Since launch in October 2022, buybacks have added approximately 71p to NAV per share, and they have also reduced volatility in the share price and improved trading liquidity. So we believe we achieved 3 very important benefits with our buyback policy. Number one, it enhances the immediate NAV per share, which feeds through the share price over time. Furthermore, our buyback program increases liquidity and reduces volatility of our shares and allows for greater market stability. And lastly, it increases our investor confidence in the trading of our shares. In summary, we optimize long-term shareholder returns through our buybacks, our progressive dividend policy, and most importantly, via our proven investment strategy. Looking ahead, and looking at the longer-term track record over both 5 and 10-year periods, NAV per share and share price total returns remain strong on an annualized basis, just under 13% per annum NAV per share total return over the last 5 years, and just over 16% per annum share price total return over the last 5 years as the discount narrowed over the period. We believe this is a very robust performance and reflects the consistency of our strategy and benefits of an active portfolio management. In order to conclude, I would like to look ahead and give you our excitement of what we see in terms of the strong momentum we've seen and carried through into Q4. Since October 31st, we have received £75 million of proceeds. We completed 3 new co-investments, which makes fiscal year 2026 actually one of our busiest years in investing in co-investments. And as mentioned earlier, we committed $90 million to LP secondaries in order to participate in a buoyant secondary market and increase our exposure to secondaries. The broader market backdrop is supportive. Interest rates have stabilized, and we see more M&A activity, and the tougher fundraising market actually benefits Enterprise Trust and gives us attractive co-investment deal flow. As I mentioned before, we had the busiest year in regards to co-investments on record. Therefore, our robust balance sheet and our strong relationships with top-tier managers positions Enterprise Trust well for the medium to long term.